Private equity is one of the most powerful forces in modern finance, and at the heart of it sits the leveraged buyout. In this video, you're going to learn exactly how an LBO works, why firms use debt to buy companies, and how billions of dollars in returns are generated. An LBO, or leveraged buyout, is simply the acquisition of a company using a significant amount of borrowed money. The assets of the company being acquired, along with the assets of the acquirer, are used as collateral for the loans. The goal is to buy a company, improve it, and sell it for a profit. The word leveraged is key. Instead of paying 100% cash for a company, a private equity firm might pay only 30 to 40% in equity and finance the rest with debt. This amplifies returns, because if the company grows in value, the equity holders capture all of that upside. Let's walk through a simple example. A PE firm buys a company for $100 million. They put in $35 million of their own equity and borrow $65 million. 5 years later, they sell the company for $150 million. After repaying the $65 million in debt, they keep $85 million, more than doubling their money. That return, over 2x in 5 years, translates to an internal rate of return, or IRR, of roughly 19%. If they had paid all cash, the same exit would return just 1.5x. Leverage is the engine that supercharges private equity returns. So who are the players in an LBO? You have the private equity firm, which sponsors the deal and provides equity. You have the target company being acquired. And you have lenders, banks and credit funds, who provide the debt. Each party has different risk and return profiles. The PE firm raises money from limited partners, pension funds, endowments, sovereign wealth funds, and family offices, into a closed-end fund. They then deploy that capital into acquisitions, typically using 5 to 7 years to buy, build, and sell companies. Lenders in an LBO are compensated through interest payments. They have seniority over equity holders, meaning they get paid first if things go wrong. Because of this, debt in an LBO must be manageable relative to the company's cash flows. The key metric lenders look at is EBITDA, earnings before interest, taxes, depreciation, and amortization. If a company generates $20 million in EBITDA and carries $60 million in debt, its leverage ratio is 3x. Investment-grade companies might carry 2 to 3x. LBO targets often carry 4 to 6x. The ideal LBO candidate has several characteristics. It generates stable, recurring cash flows. It has low capital expenditure requirements. It operates in a defensive industry not prone to economic cycles. It has a strong brand or market position. And it has room for operational improvements. Industries like software, healthcare services, consumer staples, and business services are common LBO targets. Technology companies with subscription revenue are increasingly attractive. Highly cyclical businesses, like airlines or commodities, are generally avoided. Once a PE firm identifies a target, they run what's called an LBO model. This is a financial model that projects future cash flows, debt repayment schedules, and potential exit values. It answers the fundamental question: can we generate a 20% or higher IRR on this investment? The LBO model typically includes 3 components. First, the entry, how much you pay and how you finance it. Second, the operating model, projected revenues, margins, and cash flows during the hold period. Third, the exit, how much you sell for and what returns you generate. Entry valuation is critical. PE firms typically pay a multiple of EBITDA for a business, often 8 to 12 times in today's market. If you overpay on entry, it becomes very difficult to generate strong returns regardless of how well you run the company. During the hold period, typically 3 to 7 years, PE firms focus on value creation. This includes revenue growth, margin expansion, cost reduction, and bolt-on acquisitions. These levers are how they improve the company and justify a higher exit multiple. Debt paydown is another critical value driver. As the company generates cash flow, it pays down the acquisition debt. At exit, less debt means more equity value for the sponsors. A company bought with 65 million in debt that pays it down to 40 million has created 25 million in additional equity value. Exit strategies for LBO investments include selling to a strategic buyer, a large corporation that wants the business. Selling to another PE firm in what's called a secondary buyout. Or taking the company public through an IPO. Each route has different valuation and timing implications. Let's talk about the types of debt used in an LBO. Senior secured debt, the largest and cheapest portion, is backed by the company's assets. Junior or mezzanine debt carries higher interest rates to compensate lenders for taking more risk. Together, they form what's called the capital structure. Covenant packages in LBO debt are important. Financial covenants require the company to maintain certain leverage or coverage ratios. Maintenance covenants are tested regularly. Incurrence covenants only trigger when the company takes specific actions. Loose covenants give PE firms more flexibility to manage the business. Returns in private equity are typically measured by two metrics. IRR, the annualized return on invested capital. And MOIC, the multiple on invested capital, which tells you how many times your money was returned. Strong PE funds target 20% plus IRR and 2.5x or higher MOIC. The J-curve is an important concept for PE investors. In the early years of a fund, returns are negative, the firm is paying fees and making investments before generating returns. As companies mature and are exited, returns curve upward. This shape forms a J when plotted over time. PE fund economics follow the 2-and-20 model. The GP charges a 2% annual management fee on committed capital. And earns 20% of profits above a hurdle rate, typically 8%, in what's called carried interest, or carry. This aligns the GP's incentives with LP returns. Carried interest is the most powerful form of compensation in finance. A successful PE partner can earn tens or hundreds of millions in carry over their career, dwarfing any salary or bonus. This is why top talent is drawn to private equity, and why competition to break in is fierce. The LBO is not just a financial transaction, it's a thesis. PE firms acquire companies because they believe they can unlock value that the current owners cannot. Whether through management changes, operational improvements, or strategic acquisitions, the thesis must be clear and executable. Risk in LBOs comes from several sources. Too much leverage can make a company fragile in a downturn. A deteriorating business can fail to service its debt. Economic recessions reduce exit multiples. Rising interest rates increase financing costs. PE firms must model downside scenarios carefully. The 2008 financial crisis revealed the dangers of over-leveraged LBOs. Many deals done in 2006 and 2007 at peak valuations with loose debt terms ran into trouble. Companies like TXU and Caesars Entertainment defaulted on billions in LBO debt. Discipline in entry price and leverage is essential. Post-2008 regulation tightened leveraged lending standards. Banks are now limited in how much debt they can provide relative to EBITDA. This has pushed riskier debt to private credit funds, direct lenders who originate and hold loans on their own balance sheets without bank intermediaries. The private equity industry has grown dramatically over the past 2 decades. Global PE assets under management now exceed $6 trillion. Firms like Blackstone, KKR, Apollo, and Carlyle manage hundreds of billions each. The industry touches virtually every sector of the global economy. If you want to work in private equity, understanding the LBO inside and out is non-negotiable. Analysts are expected to build LBO models from scratch in interviews. Understanding how each lever, entry multiple, leverage, EBITDA growth, and exit multiple, drives returns is the foundation of the craft. LBOs are not magic, they are disciplined, analytical frameworks for acquiring businesses and generating returns. When executed with the right target, the right price, and the right operational plan, they create enormous value for investors. That's the power of the leveraged buyout, and why it sits at the core of private equity.